So in this lesson, lesson 12, we're going to take a look at, is our second adjustments lesson. We're going to take a look at the rest of our accruals, right? These ones here. So we started with our main two. Of our main two, we started with accruals, and we talked about these two. And today we're going to talk about interest and salaries. And we're also going to talk about how all of them are actually the same process. I'm going to start with salaries because it's actually a little bit more straightforward. So it tells you that salaries and wages are not the same thing, and it gives you more detail. And of course, just like the last lesson, I expect you to read this in tandem on your own. I'm not going to read it for you. You should be able to read. And I also expect you to watch the video, pause it when I say pause, and try some of the problems, then start the video again and see how you did. Here's where the problem comes from. This is an example of salaries. So here, the employees are last paid on the 24th of July. Right? And they get paid every 2 weeks. So again, they will be paid not on the 31st, but the next week. So we go into August and they'll be paid again on the 7th of August. Here's the thing. On the 31st, so if the business makes financial statements monthly, then on the 31st, employees have worked all of these days but not been paid yet. So that's a business cost. That's a salaries or a wages cost that has been earned in July but not yet paid. And if you remember, the purpose of accounting is to produce useful information for decision making. Well, profit is not a useful number if it hasn't had all the expenses for the period subtracted from revenue. So all the wages that were earned along here need to be recorded here. And this is the same as interest. So let's take a look at interest for a minute because it's got a better illustration. Look. If you borrowed money on the 15th, on the 31st, it's the end of the monthly accounting period. If you adjust monthly or you make statements monthly, then this is the end, and you need to make all the interest cost here recorded in this month, even though you don't pay interest normally until the monthly anniversary of taking out the loan, which would be on the 15th of the next month in August. But you still have to record the interest cost for all of these days when the accounting period closes at the end of the month. Take a look at this illustration. This is why. If this is time going along, we took the loan out here on the 15th, and we're going to pay our first interest payment on August 15th. So our interest period is this month-long period. But our accounting period ends where this red line is, at the end of July. This portion right here, as it says, this portion of interest from the whole interest period, which concludes with our payment, this portion has to be recorded as expense in July. And this portion has to be recorded as expense in August. This, if you understand this, then you're well on your way to understanding accruals because it's actually the same for all accruals. Whenever an accounting period ends in the middle of an expense or revenue period, you're going to have to adjust and shift some values around. So we'll start with salaries. And again, there's more exercises for practice in here. So I'll leave those for you to do for studying and practice and stuff. And we'll do an example. We'll do the lessons on the syllabus. So let's do salaries first. So exercise 24 looks like this. And just a little quick orientation. What you've got is a spot to do journal entries for this salaries example. And we've got a spot where we can see what our balance sheet looks like and what our income statement looks like and what the ledger account looks like for any of these accounts. Down below, we've got the next activity, which will be interest. And this one, we have the same thing again for this exercise, but we also have it over here from the bank's perspective, just for some more understanding. All right, so let's do this one. So salaries of $20,000 in total are paid to employees every 2 weeks. The next two paydays are Friday, April 20th, and Friday, May the 4th. Make the journal entries for us, so our business, that's why it says our journal, on the 20th of April, the 30th of April, right, end of the period adjustment, and May 4th of this year. Use the ledger accounts and balance sheets snippets here to help you understand what's going on as you try it, okay? So this is a pause video moment. Give it a crack, an honest crack, as far as you can go. Use this, right, use this file to help you along, maybe some of the activities in here, and then watch the rest of the video. Here's how we do this. relatively straightforward, this salary one. So we're going to first record this first entry here when we pay the salaries. So what we are going to pay is $20,000. So if this is the first salaries we've ever paid, sorry, it's every 2 weeks, right? So this would be the last paycheck would have been on the 6th. So this one will be a full salary, and all of it was in April, so there's nothing to worry about. So it's going to be, I'm just going to say salaries expense and cash. And what we're going to do is put $20,000. And immediately you're going to see a couple things over on the right. We'll see now our income statement as of April 20th, 2018, shows a salaries expense of $20,000. And down here we can see in this account, salaries expense, we have a debit of $20,000 and a total debit balance of $20,000, right? And there are no salaries owing because we're going to pay them. So we credit cash $20,000, done. Relatively straightforward. The issue comes now here on April 30th, which is 10 days after April 20th. So on April 30th, 10 days of salary have been earned by employees and 10 days of salaries cost has been earned by the business. So we will have some kind of salaries expense. But April 30th is not a payday. It hasn't been 2 weeks yet. So we're not paying anything. There's no cash involved. It's going to be owing. We have to record 10 days of salary. But it's owing at this point because it's not a payday for employees. Do not use your phone or a calculator for this. You should be using the spreadsheet to develop these skills. Plus, it's a lot easier to then copy and repeat these entries because adjustments tend to repeat every month. So we're going to go, it's 10 days, right, of 14 in the pay period. So 10/14ths of a full pay, and a full pay is $20,000. So that's going to be $14,285.71. Now, here's something I always tell students. If you have a lot of adjustments before you sort of total up, this kind of thing can cause a problem because these spreadsheets only show you 2 decimal places, but they have more unless you round yourself. And if you go 10 times, you'll be off by 4 cents. And if the computer is marking it your practice assignment, being off by 4 cents is not equal to a computer, so you won't get the mark. So you have to be aware of the fact that hiding decimal places is not rounding. The fancy way is to round, and the round function in your assignments is you go equals round, open bracket. And then you put your formula or your calculation, and it's going to round that. And at the end, you put a comma. Once you've calculated it all, you put round in front, and at the end, you put a comma. And then after the comma, you specify how many decimal places to round to, and you close it. And now it rounds automatically, right? Before, it wasn't rounded. It was just hidden. Now it's rounded. So the big idea here is that this and all these are hiding decimal places. They're not actually rounding. So keep that in mind. So, which hasn't mattered before until maybe with HST, but it definitely matters with adjustments because you get all sorts of fractions and calculations like this. So $14,285.71. And we are crediting, remember, not cash, not paying anybody. We're going to credit salaries payable. And now we see, as of April 30th, the end of the month, we are owing. So this is our liabilities, right? So this is our balance sheet. So salaries payable, $14,285.71. And our total expense now, as of April 30th, for the month of April, not counting April 6th, is this. And then down here you can see this expense for salaries expense. And in the payable, we can see we have credited the liability of $14,285. Okay, so what do we do next? Well, the next day that matters with salaries is the next payday, which the question tells you is May 4th, 2 weeks after April 20th. So the pay amount is $20,000. So whatever you do, you have to be paying $20,000 of cost. You also are going to have more salaries expense, right? Because so you've got the May 1st, 2nd, 3rd, and 4th that's taking place in this pay period that has not been recorded. You've recorded 10 here. You need 4 more here. So let's actually do that first. So that's going to be a similar formula. This is one of the reasons why it's helpful to use the formulas in the cells. But instead of 10/14ths, it's only going to be 4 days. So 4/14ths of a pay period. $5,714.29. You can now see that our expense, now that we've recorded this expense, our total expense so far is 2 full pays, 20,000 and 20,000, 40,000 in total. We are not going to credit cash yet. We still have to, we're going to pay though. Actually, let's do that. Let's credit cash of the full amount. And the missing value, of course, is this. This is payable as of the end of April. We recorded the expense. We showed it owing, but not paid because it wasn't a payday. But now we're paying it. On the 4th, we are paying the full paycheck, which includes this cost from April and this from the first 4 days of May. So we debit salaries payable to erase it. Watch on the balance sheet as of May 4th, this is going to go away. So we debit the payable. Now salaries owing is back to 0, and we pay the salaries for a total expense of 40,000. Right? Here's the payable. Goes in at the end of April, and on May 4th, we erase it because we're going to pay it, with total expenses being the 20th, what was accrued on April 30th, and the last 4 days recorded on May 4th when we actually pay these two. This is us now taking out a loan on March 9th. So this is interest. And let's go back to our note because this is important. If we go back to interest, there's a couple things you do have to read about. That's why I say you have to read this. You can't just do this practice, you have to read it. So we've been through this in this lesson already, but we haven't stopped for this here, right? So interest is usually paid monthly on mortgages and loans. And interest, so if you're just told 4%, interest is almost always an annual number. So if someone says you're borrowing at 4% interest, it means 4% per year, unless they say otherwise. So if they say 4% per month, then it's per month. But if they just say 4%, it's standard in industry that interest is an annual number. Got it? So then on that note, try this one. So we take out a loan on the 9th, amounting to $50,000 at 3% interest, which means 3% per year. Right? Here's what you need to do. You need to record the entries necessary to get the loan, adjust it for all periods until the loan is done, right? It's a 3-month loan. And then you need to dispose of the loan at the end. And then I want you to do it for both us, so in our journal right here, and then over on the right for them, which is the bank. I also want you to look at these after each journal entry to see what's happening to the financial statements, to our income statement and to our balance sheet as of the dates that they'll show you, right? To our interest payable, our loan payable, and our interest expense. Same over here. For the bank, it's going to be interest receivable, waiting to get the interest. Loans receivable, when a bank makes a loan to you, it's an asset to the bank that it's waiting to get back. And then interest revenue as the interest gets earned and paid. Right? Give that a crack. But before we do that, I need to point out something really important that's going to come up again and again and again, especially in grade 12, if you take accounting again. These things right here, acquiring, adjusting, and disposing. That's what accounting is really about. Bookkeeping, yes, but accounting especially, it's really, when you start to get really advanced, you have to learn how to acquire any asset or liability, how to adjust it and modify it as time goes on, and then how to actually dispose of it properly. And these are the steps. First is acquisition. And when you acquire we'll keep it simple and keep to assets. When you acquire an asset, you need to include the key idea, and this is an eternal point you have to remember for as long as you deal with accounting, is you have to include an asset that provides future benefit to a business, right? So when you record its cost, you have to record it at cost at this point. But what cost really means is you have to include all costs. And the key concept is necessary to get it ready for its intended use, to acquire the asset, in other words, to buy it, to have it shipped, necessary to acquire and get it ready for intended use, right? So in other words, if you buy a machine across the border and you have it shipped and it needs to be insured while it's shipped, then you have to pay a customs agent or somebody to inspect it and make sure it makes it over the border. And then you get it to your place of business. You have it installed. You pay to have it installed. Then someone from the government has to come and inspect it and make sure it's okay. All of those things would cost money, and all of them would be part of the cost. So in your accounting records, would be part of the cost of the asset because they're all necessary to acquire it and get it ready for its intended, use. That's acquisition, which is what that says if you can't read it. The second thing you have to worry about is what we're kind of learning now, how to adjust as time goes on. So in other words, if it's interest, how do you record the interest even though you haven't paid it yet? And then later on, shortly after the adjustment day, how do you actually pay the interest and so on? So how do you adjust it as time goes on? And then the last part is disposal. So how do you actually get rid of it? And the fact is that at disposal, you have to make sure any adjusting that needs to be done is up to date, up to the date of disposal, right? So any adjustments have to be up to date. The next thing you have to do is that if you have to know what the book value is, and if you don't know what book value is, this is a key concept. It's in the text-based note on the webpage as well. I mean this one. So if you look it up, it'll talk about it. Mostly when you get down here to amortization. But book value is essentially what is the asset worth on your books. And that matters because you also, I'm just going to write over here, proceeds. So proceeds, so in other words, the money you get for an asset, if it's an asset, so proceeds minus book value is going to equal capital gain. In other words, you sell it for more than it's worth on your books. Or if it's negative, it's a capital loss. And you have to deal with that too when you dispose of it. And then last thing you have to concern yourself with when you dispose of an asset is you have to actually erase all the accounts that are associated with the asset. That's an N. You don't have the asset anymore, so you can't have any of the other accounts that might be associated with it. And you're about to discover why you might have more than one account associated with an asset in the next lesson. So on that note, keep that in mind because it's sort of the first time it's come up, but it's going to come up again and again and again as you study accounting. Okay, so let's pause the video and try this interest question. Here we go. First day is March 9th, right? You should have got that much. The first thing you had to realize was, what do you do when you borrow money? You may have not, I've seen too many journal entries like this, but you borrow money because you need money, right? That's what it literally means. And when you do it, you get money. So we have to debit cash $50,000. And it's not yours, so you owe it. So you have to go and you'll credit loan payable also for $50,000. There's no tax, there's no HST on borrowing money. So that's what it looks like. So let's do a quick little examination on March the 9th. Our balance sheet is going to say, as of March 9th, that we owe no interest because our loan's brand new, so there's no interest, right? Because that accrues as time passes. We owe $50,000 because we just borrowed it and our total liabilities is $50,000, right? Makes sense. So it's 3% interest. There's the acquisition done, and now it's just a whole bunch of adjusting until the loan is done 3 months from now, which will be April, May, June 9th. Okay. So the next date that matters then is going to be March 31st, the end of March. And we're going to have to adjust. Step 2, one of our many adjustments, one of our 2 or 3 adjustments, right? So we have, at the end of March, we're going to have interest expense. Question is how much? Well, how many days is it? It's 22 days from March 9th to March 31st inclusive. So here's how interest works. Unless otherwise told in this course, assume that interest is a daily amount. So in other words, there's 22 of 365 days that from March 9th to March 31st. So 22 of 365, and that's the fraction. And we use that because that's the fraction of the interest rate, which is 0.03. That's 3% as a decimal. So that's a yearly amount, which is where the 365 days come from, right? So here's the interest rate for a year. Here's the proportion of a year that has passed from March 9th to 31st. So when you multiply that, that's the interest rate to apply to $50,000, the amount that we owe. So we multiply that by $50,000 and we get interest of $90.41. And if you were paying attention in the last lesson, there's more there than 2 decimal places. So we have to do our little trick to make sure that we don't shortchange ourselves and miscalculate ourselves. So we're going to round this, and once we've calculated at the end, we'll add the comma, round to 2 decimal places, and there we go. We're not paying it at the end of March. We pay it on the anniversary of borrowing it, which will be April 9th. So we credit the liability. We've recorded the expense. Now we have to record the credit, or what doesn't balance. So we owe the money, but we're not paying it. And that's what it looks like. So let's examine our statements now. So our interest expense so far, as of the end of March, is $90.41. Right? Our interest payable is $90.41 plus the loan payable of $50 makes this our total liabilities. Let's do the next one. The next one is going to be the date we actually have to pay the interest to the bank, and the bank will just take it out of our bank account. Right? So it's going to be April 9th, and we're doing a debit interest expense as well. Just like if you've watched the previous lessons, or this one actually with salaries, right? It's the same thing. There are 9 days in April for which interest has not been recorded. So the interest expense, go back up here, we're going to take this, we're going to steal it. We're going to steal this, we're going to copy it, paste it down here, and instead of 22 days, it's actually 9 days in April of 365. So 9 365ths of the annual 3% interest, multiply that by what we owe, and that'll give us our interest expense within this rounding function so that it rounds to the nearest cent. So it's $36.99 of interest in April before we have to pay. So now you can see the interest expense total as of April 9th, since we took out this loan, has been $127.40. Notice how it hasn't increased what we owe, because on this day, April 9th, we're going to actually pay it. And here's our total interest expense. This, which was the adjustment for the end of March to make sure we recorded the right amount of expense in March, this is what's happened in the first 9 days of April, all of which we are going to pay on this anniversary date. This expense for April, this is very much like with the salaries, right? So the interest payable that we recorded here in March, we're going to debit because now we're paying it. And notice the payable is going to go away. So we no longer owe it because we're going to pay it right now. So we're going to pay the interest from March, and we're paying the interest in the first 9 days of April. And the total is just going to be the sum of these two. $127.40. Done. So as you can see, expense, and you can look at the payable too, right? That in went the payable at the end of March, and on the 9th, we paid it. So it comes out and the balance is 0. Guess what? This all repeats. Copy, paste. So on April 30th now, at the end of April, we need to adjust for the interest in April. And that's going to be, it's now going to be, what is that? It's going to be 21 days in April, from April 9th to April 30th. So it's 21 days of interest, which amounts to $86.30. So I'm going to delete this for a second. So now, as of April 30th, our balance sheet is interest owing $86.30. And then this expense recorded but not yet paid brings up our total interest to this. So if we look at all our interest charges, our interest expenses are adjustment for March, the first 9 days of April when we actually pay the interest, and then the adjustment for April for the interest from the 9th to the 30th, right? Okay, so then undo. Now on April, this will be May 9th, the next anniversary, we're actually going to pay the interest. So it's going to be the 9 days again. So this is for 9 of the 365, so that's fine. So this is 9 days interest in May. This is the interest that was accrued in the adjustment for the end of April. Earned in April, but not yet paid. So interest expense for May. The adjustment for April, we're debiting that payable, right? Because before we did this, remember we owed this. This was payable as of May 9th. Now we're paying it, and this goes away, right? Payable in, paid on the 9th. Payable in for the adjustment at the end of April, paid on the 9th of May, comes out nothing payable again. Right? So we pay this for May. This remaining from April is all paid at once on the anniversary date. Done. Next, it repeats again, right? So May 31st, you will have an interest expense. It will be from May 9th to May 31st. It's going to be the same old formula, except it's going to be 22 days again. This is a 31-day month. So from the 9th to the 31st is 22 days. Then interest payable for the same amount, bringing our total expense over the period for the loan period to $341.10. The owing as of the end of May, $90.41 again for 22 days of interest. Right? And then when we go to pay on June 9th, you'd have something similar, except this is now 3 months since we borrowed the money. It was a 3-month loan. So we have to actually pay back the loan on this date. So this is what's owing. We have to accrue the 9 days of interest in June still, right? So we're going to have interest expense, and it's going to be this same formula, except for 9 days. So we'll just go in here and change this to 9. $36.99 again. And we're going to pay the interest from May, which is payable. And now that payable is going to go away, right? So we no longer owe that. So they're in, out, in, out, in, out. And then our total expenses are $378. So that's all the interest now recorded. End of March, the first 9 days of April for the first payment. Next payment, third payment of interest in total, right? With the adjustment periods coming in between each time at the 31st, end of April, and end of May. Next, you have to get rid of the loan payable because this is the end of the loan. So it's like a short-term loan. So you got to get rid of the payable because you're now going to pay it back. So now we have no payable, and to balance this journal entry, we have to pay the interest from this month, from last month from the adjustment, and pay back the loan. And that's just simply a matter of totaling all of these things that need to be paid. There you go. That's how it works.